Let's talk about another dividend company and find the intrinsic value of its share. Please remember that this video is not financial advice and is for entertainment purposes only. Devon Energy Corporation is an energy company engaged primarily in the exploration, development, and production of oil, natural gas, and natural gas liquid. The operations are concentrated in various onshore areas in the United States and specifically in these 5 states: Texas, Oklahoma, New Mexico, Wyoming, and North Dakota. This company has only one equity security that has the ticker symbol DVN. They report their operations in a fiscal year that ends on December 31st, and the audit report for 2022 is clean. If you look at the analysis report that we made, in 2022, this company made about $19 billion in revenue. 69% of that came from crude oil, 16% from gas, and 15% from natural gas liquid. When we look at the revenue graph, we can say that it's interesting because at first glance, we can say that it's not consistent. But if I zoom out a little bit, we can compare the revenue graph to the average annual crude oil price graph that I found on Statista website. If we look closely at the same period that starts from 2016 to 2022, we can see how the two graphs are very similar. An increase in 2016, then a decrease in 2020, followed by a sharp increase in 2022. In the revenue graph, we're missing the last decrease because this analysis report has data up to 2022, and we are trying to figure out the 2023 direction. But if you agree with me about the similarities in the behavior of the two graphs, then we can say that 2023 revenue for this company is going to decline. The free cash flow has a similar story of inconsistency, which is an unfortunate thing for us because it's harder to forecast next year's free cash flow. Checking on the solvency, the debt level doesn't worry me because in 2022, the debt to asset ratio is only 27%, which means that this company has so much more room to get more debt for future growth. And the times interest earned ratio is 28 times. This ratio works like a measurement to check if the company can afford to service their debt, and they made 28 times what they had to pay for interest in 2022. Checking the outstanding shares for the past few years, the graph of the outstanding shares actually tells a story. In 2020, there was an almost 76% increase in the outstanding shares. That happened because this company acquired another energy company that's WPX. And for each share of WPX was acquired, Devon Energy Corporation issued 0.51 share. So in other words, Devon Energy Corporation financed the acquisition by issuing stocks. Moving on, this company is a dividend company for the time period we're analyzing. The 2022 dividend was about $5.17 per share, and this amount is out of the ordinary because in 2021, the dividend was not even near that amount. Using 2022 dividend and the current share price, the dividend yield is about 10%. But we have the 2023 Q1 report, and it shows that the dividend for the first half of 2023 is $1.61 only. Double that amount if you want to have an idea about the 2023 dividend, and you will get $3.21 per share. Then the expected dividend yield is 6.45%. The last step we have is the forecast. To forecast the revenue, we'll be using the asset to revenue ratio because the assets like the oil field and equipment are the main thing that this corporation needs to generate revenue. This ratio is not consistent in the past few years because the commodity price was not consistent. And we know that crude oil prices are going down lately, so we need to be very conservative in this forecast. The average of the asset to revenue ratio for the past 5 years is 62%, so we will be using this average. The free cash flow of the first quarter of 2023 is about half the free cash flow of the same quarter of 2022. So I will use this fact and suggest that the free cash flow to revenue ratio will be much lower than 2022 ratio. So we will assume it will be 20%, which is 60% of the prior year's ratio. The third item to forecast is the outstanding shares, and the company continued to buy back more shares in 2023 and reduced the outstanding shares by about 1.88%. So to be conservative, we will assume that they will not buy back any more shares in the remaining 3 quarters of 2023. The discount rate that we will be using is the 6 months Treasury bill interest rate. I'll put in the description box a link if you want to know how to look up this rate. Finally, we will use the expected dividend yield in 2023 as our return on investment ratio. These 5 forecast keys will give us about $14.7 billion in revenue and about $3 billion total free cash flow, which means $4.58 free cash flow per share. Using the expected dividend yield ratio, the intrinsic value is $67.45 per share. But since there is so much uncertainty concerning the revenue, we should increase the return on investment ratio, and I suggest 10%. So this will change the fair stock value to $43.48 per share, which means it's overvalued by about 14.5%. Please let me know what you think in the comments section. Have a great day and fabulous investment opportunities.